if we think just imagining, right, digital asset markets or crypto markets coming in among big institutions, what would be the ideal settlement kind of mechanism? How do you think settlement could or should look in a new market like this?
I mean, the most effective mechanism would be something versus payment with a netting function. Mm-hmm. So if in any construct you can bring a risk exposure to a multilateral netting capability and then net down the actual funding requirement and then settle that versus payment, that's a great outcome. It's the question of like how frequently you can do that and at what speed. And some folk and it's always an and. People always talk in this space about I could do this or that. It's like, well, no, I can do that and that. And in the and space, if I have a process of doing things now and I can do something new, if that new thing is really good, then liquidity will flow there. And then the existing thing needs to think, well, okay, how do I balance that out? Or am I comfortable? Is the market comfortable with that transition? So I don't think there's a specific model. It's just, in a principle level, netting and versus payment. So I fund as little as possible and I reduce my settlement risk exposure to zero, then that's a good outcome.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. My name is Ian Simpson, and if you want to know what banks, securities firms, hedge funds, asset managers, and others are doing in crypto and digital assets and how they're doing it, this is the place for you. My guest today is Scott Lucas, Managing Director and Head of Markets Digital Assets at J.P.Morgan in London. He is also a board member at HQLAX and Onera, as well as the FX settlement giant CLS. Before his banking career, he also had a military career, serving in the Australian Army and the British Army, with tours of duty in East Timor, Northern Ireland, and Iraq. He joins us today in the studio here in Zurich. Scott, welcome to RULEMATCH Spot On.
Thank you, Ian. Looking forward to it.
Good. So today we're going to dive into a few topics, maybe high-level perspectives on DLT, blockchain, digital assets, and so on from your personal perspective, but also that of a big bank like J.P.Morgan. Then a little bit kind of the tectonic plates moving under the surface, capital markets, how things are shifting, where things are going. And I think it'll be quite interesting to cover also maybe some of the things that have been missing or developing that perhaps have been hindering institutions in this new space kind of in general. But first of all, obviously you come to us from J.P.Morgan, very, very large bank, one of the largest banks in the world. Nobody necessarily needs an introduction in that sense, but I'd be interested to hear from your perspective and the perspective of a bank like that, generally, since your opinion matters, what makes good markets? What makes a good market for institutions, for people, for the financial world?
Yeah, and that's fair, I think. And looking at it through a markets lens, I think it's really capital markets doing what they're meant to do, which is sort of be as broad and deep as they possibly can to bring as much value to the transfer of that capital and liquidity between the client set as it possibly can, and whether that be extending loans or being able to trade things in the secondary market or be able to support liquidity requirements for our clients or whatever, like anything that sort of supports that overall objective of what capital markets are meant to do, not like and our bank's role in it is met appropriately. That's kind of what makes a good market. And that also takes a few other factors around like control. So if we're really thinking about the transfer of capital between sort of different participants in the market, at some point, that's someone putting risk on the table. And you kind of want to make sure that there is a appropriate legal framework, that there's the appropriate regulation, there's appropriate protection for those investors that make it a market they'd want to be part of, and they've got confidence in taking risk in that market. So that's quite a key component. I think making sure it's large enough, so it's liquid enough, there is the opportunity if you want to sell, you can sell, and there's buyers for sellers, etc. And I think also just having something that actually does the risk transformation in the way that you want. So you're taking, whether it be investing straight for yield, whether that be, trying to offset some sort of exposure with a hedge, et cetera. There's an outcome-based dynamic to that that's important. So if you've got a controlled environment that's got the right legal underpinning and so the right regulatory framework to protect, the participants in that and make sure that, the behavior and the standards of that market are sound that we want to participate in. It's deep enough and wide enough to bring capital and liquidity so you can actually offset a marketplace with each participant that you need, buyers and sellers, et cetera. And you've then got, products in that market that actually meet the needs of the participants who want to be there. Those things all relate to each other in a way that I think is quite important. And actually some of that feeds into some of the challenges around where blockchain and DLT is now, as opposed to where it could be, and also some of the opportunities that we see in that space. So that is how I would think about what we would consider a decent market to be part of, and how we service our clients in that market is really quite important.
Mm-hmm. And from your perspective, is there kind of an optimal mix? You mentioned a few factors there between innovation, control, risk, regulation. There's no magic formula, I know, but...
No, I would say rather than optimal mix, I would say a minimum threshold. Mm-hmm. And so, to be successful, you need to have the right products. Those right products need to be in a construct that we're comfortable with the legal and regulatory standards. So it's above a threshold that's been built over a long period of time and that has been sort of driven off good and bad, market events in history and saying what's good and what do we want to avoid. There's a threshold there that needs to cross and sort of get comfortable with taking that risk. And then there's enough people in that kind of want to operate. So I would say, it's less a optimal mix than it is a minimum threshold sort of above which you want to operate.
Okay, very interesting. I mean, we talk about markets, traditional markets, which you can argue whether they're digital already. There's a lot of digital already in traditional markets. But, a lot of things work pretty well. I mean, J.P.Morgan, other big banks have been in the markets for a long time. You could say in one sense they're like a well-oiled machine, or maybe, as you might understand from military background, a well-disciplined unit. Everything has its part, everything works together, and so why change it, right? Is that kind of how you see markets in general?
Almost. I would say, if we just took that perspective, why change it, then we wouldn't have further advances in how markets can be operated in a more efficient way. We wouldn't be in a position to think about new and more innovative products to bring to clients to do that job of extending the transfer of capital in a safe way across as many participants as possible and widening and deepening that capital markets footprint. And you could say that at any point in history, you could say, the markets worked pretty well when they were on paper, right? Because there was a control framework around that. But now, there's much deeper liquidity and there's other potential factors and benefits around moving to a more electronic market structure. There's quite a lot of work to get through in order to understand not just what the new opportunities are and how you would add to the existing market with some new products, but how those might evolve over time. And I think that's part of the dialogue that's happening now around sort of what blockchain could do, what it should do, and what it will do in different time horizons.
Mm-hmm. Time is always a fact, but coming now to DLT, but in the first step, crypto, which came first, obviously. This whole technology together with the financial aspect of it started with Bitcoin. Then, of course, institutions came along and said, well, maybe not Bitcoin, but the technology is interesting. And those things have developed. For many people, that minimum barrier hasn't been there yet for being in the crypto markets. Is that kind of the biggest barrier for financial institutions, do you think? And maybe more specifically, what would be kind of the minimum barrier that you see in crypto markets?
Yeah, I think when it comes to, and rather than calling them crypto, I think maybe just saying markets that are built on a more open architecture with less of a control framework about who's in that market and what they need to do in order to be compliant with market standards. That's a risk appetite question. And it's a risk appetite at a few levels. There's the sort of broader jurisdictional regulatory risk appetite, what you're allowed to and not allowed to do. And then there's the institutional, our own footprint. Like what are we interested in doing? What are we comfortable with from a risk appetite standpoint? And then there's clearly the client about what they want to do. And they don't always line up exactly. I would say, we've moved in the United States from what was a more restrictive environment over the last few years, and I can understand why they were there, to a more permissive environment. What that permissiveness looks like and how we interpret that and what our risk footprint and our risk appetite in that environment equals, we're still working through because there's still some
not quite to the finish line yet.
No, it's not. But I think it's a healthy debate to have. And so, if there's an opportunity to explore new capabilities in that or alongside that market, then we should do that. But we should do it in a measured and sort of, balanced way, not in a hands-free, like go and do whatever you need and we'll see what breaks way. And I think most institutions and most companies that operate take very much a, very prudent approach to ensuring that whatever they do in whatever structure, whether it be in a more open architecture or whether it be in a more controlled architecture, do take that approach. I'd like to think that's sort of certainly it's the standard we hold ourselves to, and I would imagine it's the standard most of our peers hold ourselves to. And it really is, when you think about it from an institutional standpoint, an institutional investor standpoint, the standards they have to hold themselves to because it's their capital at risk as a principle. And that matters when it comes to their underlying liquidity providers and sort of the initial source of that capital. So I think there are some natural breaks on sort of just open activity. But as an institution, we look at a number of those factors, and I think it's interesting and it will be very interesting over the next couple of quarters to understand what is the art of the possible, and not only what's possible, but what's useful. Because
useful
because
you or a client?
For our clients, I mean, we're not an institution that exists in of itself. We're financial services. Service suggests that we're providing some services to clients. If there's resources that we have they want to deploy against a specific product, that's got to be for a point that's useful for our clients, it's useful for us, it's useful for our shareholders to deploy capital that way, and we get the balance of those things right. So, in that construct, I think figuring out over the next couple of quarters where the opportunity lies, not just from a what can we do, but what should we do, and then what will we do, is a debate we're having internally now, and really trying to explore what the right choices are for us as a franchise. And I think the whole market is doing that in the United States, to be fair.
So there's that kind of regulatory risk that has, to a certain sense, been mitigated now, at least with some of the shift that has happened. Are there kind of other risks or factors that you would be evaluating now when you think about the markets, whether it's structure, whether it's where do you trade? How do you trade? How is it, even just the nuts and bolts of things? How do you kind of evaluate that?
Yeah, I think, look, there's a set of regulations or a set of, permissions under which we can operate in any jurisdiction. And then there's the sort of associated kind of like legal documentation associated with the specific products in that jurisdiction. And then there's often a body of case law or history around those products that's going to lead people to understand how much the risk they want to take and kind of what that looks like. And that's why, if you go to the SIFMA website and you download a master repo agreement that's sort of publicly available, and you, as one institution to another, say, should we just sign this? That rarely happens. There's obviously nuance from each party on how much risk they want to take and what they think the credit provision should be, and are there specific legal terms they want to negotiate. So when you really think about just putting a new technology in the market, that's great, and the technology has a whole bunch of things it can do. But in order to actually put risk on the table and someone say, yeah, I'll put that money forward for that particular trade, and I'll trust you that the settlement will happen and I'll receive my asset and you'll look after that, or I'll leave a deposit with I trust you that you're going to look after that appropriately for me, or I'll trust you that you'll custody my assets in a way that I know that if I need access to them, I'll get those. That's different to having a technology that can do it. And that's where I think some of the the reality bites when it comes to deploying products into the market. And so where I think there's been success in some of the deployments has been where there's a decent hybrid of, okay, the technology can do X number of things, but these two really make a difference. So if we use those two capabilities alongside existing legal documentation and existing operational processes does that give me something that is additive to what I can do in the market today? And does that additive thing equal value for us and for our clients? And so they're the sorts of questions you have to ask yourself around, like, is it worth making the investment to get there? And can I see someone actually taking risk on this product because they understand what the underlying legal terms are? They don't have to invest an enormous amount in new operational processes. They can onboard to a technology to do something they can't do today. And that's hard. Getting and it should be hard. There should be a high barrier to that. Yeah. So that's where I think there's been some success in the market, and I'd point to our digital financing product, which is an intraday repo that's been around for a few years. Yeah, there's some specific parts of the market and some specific clients that have real value for that, because now you can do something with the technology that you couldn't do with existing technology. There wasn't the ability to trade today, settle today, mature today. Mm-hmm. Now there is, using that technology, but it also uses master repo agreements and global master repo agreements. It also uses existing tri-party allocation methodology and substitution methodology. It also uses existing account control agreements that are familiar from a legal and sort of other standpoint to both the client set and us. So it builds on both of those to solve a specific problem. And the whole repo market isn't going to go that way. Like that wouldn't be sensible. But adding something new for enough clients where we think there's value, and then broadening that across the market, we do feel that sort of navigating a path through some of those constraints and some of those realities of putting a new product into the market.
And that makes a lot of sense, because again, you say you don't want to redo things from zero, from the ground up. You want to keep what works well, what is good, and what everybody knows and is comfortable with, and then the additive part on top of that. I mean, that's kind of what people have explored, J.P.Morgan, but others with the technology. Just kind of backing up high level, and maybe even from your personal perspective, when you think about DLT, blockchain, what are kind of some of the 1, 2, 3 high level benefits of the technology in general that you see? Is it transparency? Is it, the speed of transfer? Is it operational efficiency? How do large institutions think about the technology in general?
Yeah, so I think if you take, where do we started? Like, what does it give us now that we didn't have before? So on the sort of mobilization of collateral, whether it be through our platform on digital financing or whether it be through HQLAX, which does that sort of across a range of market participants, the ability to transfer ownership of securities, either versus cash or versus other securities, in a versus payment versus delivery at a specific moment in time in a faster method, like that's enough of a uplifting capability to have value. So kind of that's useful, right? If you think about, from a fixed income standpoint, we have issued an instrument in the United States. There's been a bunch of issuances in Europe, et cetera. There's a useful argument to be had there around if you thought about a market structure which was wider and flatter rather than deeper and centralized. And I would say a distributed, not a decentralized market, because going back to the sort of control piece, like if you've got a set of participants that operate within a specific architecture, rather than having multiple layers of, redundancy and operational backup, if you could distribute that risk across a range of participants, and you've still got control and you've still got the ability to execute a number of the sort of life cycle activities, whether it be the buy, sell, a repo, a coupon payment, a redemption, or whatever, like if you could do that, then I think there's some real benefits, and you could look at a lower cost sort of market infrastructure that would make that market quite competitive. That's a really big ask. Like that's a question that either a regulator or a
huge
market.
I mean,
yeah, and it's also like, if a regulator tomorrow or a market tomorrow said, "Hey, we really like this, let's do it," 10 years. You just look how long it takes to, if you think about Target 2 securities as a project, you think about a replacement of a real-time gross settlement system. These are things that we understand. They plug into existing models. There might be new technology and new ways of doing it, but it's not a whole different architecture. That takes a long time. So I think that there are opportunities there, and we should explore that. And I think there will be enough participants in the market that are looking to explore how capital markets can operate in a more public blockchain sense that will drive a bit of innovation there. Now, whether that takes off or whether that sort of, flounders over time, we'll see. But I think that's always been the way with different markets and different market products. Innovation comes to the table, people take risk on that. Some succeed and go on to be, sort of substantial and enduring products in the market, and some don't. And, I think the next phase of this will be to see whether there's the ability for, companies that want access to capital markets but want it in a different way that they see as more aligned with how they would like to see the capital markets operate. If they can initiate, liquidity pools or different products in different jurisdictions in that way, whether that takes off. And that's a really interesting question to think about. I think it'd be some really interesting projects that happen in that space over time. And quite clearly, as we have a very well-established broker-dealer business that we would want to continue to service our clients across the range of things we thought were useful. Like if business starts to migrate towards that, then we would need to acknowledge that and figure out what our role would be. I think there are some interesting components to the technology that enable a range of different things that you can't do today. Some of it is around transparency is a misused word. Transparency for entitled transparency, I think, is important, not just pure transparency. And entitled transparency could be for the issuer looking at their instrument in a different way. It could be for the bank that's managing the hedge to be able to see things in a different way. It could be for a regulator to be able to press the button and say, I want to know the state of our government debt market in this jurisdiction, like now, who's got what. And you could, in that construct, you could probably see that. Is it worth shifting to that construct for those specific things? The market will decide over time.
You mentioned the word shift, and that shift is happening in very various ways. I had the conversation with David Newens some time back talking about some of these same things, and we talked about top down versus bottom up. Is it the regulator, the central bank, somebody from the top coming and saying let's redo capital markets from A to Z? Probably not, as you say, not going to happen overnight. On the other hand, people innovating and from the bottom up, permissionless blockchain, building products that then get traction among clients. How do you balance that, or how do you see that top down versus bottom up? Will it be both? Probably
it's got to be
both.
It's got to be, I think, and maybe.
And how does a bank kind of balance those two?
Look, when it comes to sort of regulation, like we operate in whatever the existing regulatory structure is today. And if there's something that we want to get clarity on, we can go and have a conversation with the regulators about that. And it's usually a really interesting and useful dialogue where we'll explore what we want to do, we'll explain where we think the risks are, and they'll give us a lens from their perspective. And that's really valuable because we see it from our angle, but getting an angle from the regulators is always very helpful. But that also starts to inform the regulators about what is the market interested in, and how might that help or not help how we think about the market that we're operating in. Equally, it would be unusual for any particular body, whether it be a regulator or a central bank or even just a single institution, to establish a thesis of this is how it's going to work, not test it in any way, not have any real R&D of people actually taking risk and really working through what it looks like and saying this is how it's going to be. So I think it is both. I think there will be a bunch of R&D type efforts, and there have been over the last number of years, that inform what is, I think, an evolving thesis about what the opportunity set is. That at some point either the market will say we really, really like this, we want to go that way, and there'll be momentum behind the market that will then work with regulators to establish in what construct would that work for that market. Or regulators might say, we really, really like some of the features of this. Given where our broader market infrastructure is, maybe it's coming to end of life. We expect that the next version of this contemplates or maybe deploys on a different architecture. And either of those, I think, are possible. I don't think either of them would happen without the other. Because even if it's bottoms up, at some point, the rules in that particular market and the regulations around that particular market have to be established to enable it.
Sure.
And there will be different roles and responsibilities that surface and different liabilities and risks around that surface. So that then needs to be accounted for in the broader regulation and vice versa. So I think it's both.
When we talk about shift, and you mentioned the regulation, and of course the U.S. Perspective has changed a little bit in the last few years. We in Switzerland, are happy to have had perhaps a little bit of a head start in some things. You know about the DLT law in Switzerland since 2021, DLT securities being a very interesting possibility, and pretty much laid out what they can be and what they will be. How do you think the U.S. as a perhaps fast follower comes along? How does that shift happen, and how, which direction does it go? More like Europe, different? How does it kind of align in the next phase, or how would you like to see it align?
I don't think it's easy to say like where it will land. I think the reality is we've gone from more restrictive to more permissive. What more permissive looks like when it sort of lands actually in the market I think is still being discussed. And there's some really positive things about enabling different types of activity in a market, but they need to be enabled in a way that sort of ensures that there's an appropriately level playing field for participants who already have invested in like type products, and enable that innovations. And that's difficult to get right. Because again, if you put the barrier to entry so high that it doesn't make an investment thesis, then nothing ever changes in the market, and we don't get more efficient and more cohesive and more liquid capital markets. But if you drop the bar so low, there's going to be a problem, and once you've kind of broken something, it's really hard to get it back. So I think it's a really hard job for lawmakers, regulators, and even just institutions to then understand what the risk appetite is in that construct when there hasn't been a lot of activity there. So that's why I think it'll take a little while. When it comes to sort of the United States and how it looks at the broader activity in this space, there has been a lot of cross-pollination of ideas, I think, through a range of different industry bodies, whether it be trade associations, whether it be some of the sort of regulatory bodies that meet. It's not a zero start point for the United States. They have had a pretty solid eye on what's happening in other jurisdictions, and I'm sure they'll learn from that. And there'll be things that they like about jurisdiction A versus jurisdiction B, and vice versa. I do, but I come back to the point that having some considered rule changes around what's possible to enable what should still be a safe and consistent market structure, but it allowing new ways of perhaps accessing that or transferring value in that market structure, that's something that I think is certainly worth contemplating.
Mm-hmm. I mean, Switzerland is a smaller market. It has a different place in the world, obviously. But if you read FINMA's latest report last year, 34 banks are doing some business in crypto. You have regulation in place. You have many things happening. Obviously, lots of things you could learn from and
yeah, totally.
Implement.
And it's a sophisticated market, and it's taken a real leadership role in a lot of the conversations that need to be had across different global markets, not just compared to where it is versus the United States, but also versus Europe or the UK or some different jurisdictions in APAC. So I do think there's been an opportunity for people to look at Switzerland and sort of see examples of what's possible in a market that is established and well regarded.
Mm-hmm. Is there some, and just wishful thinking, do you think there's some starting point legislation from the perspective of a big bank that would be kind of like the first door opener to a bigger? Is it capital requirements? Is it what might be the?
Yeah, I would say. Well, I mean, capital requirements are less legislation than sort of regulation, I guess. From a and even then, depending on the jurisdiction, there's different ways you can go about that. I would say, if a market, jurisdiction, whatever you want to call it, is interested in understanding the potential of what blockchain can do to add to the existing market structure, and I very much say add to the existing market structure on purpose, because I don't think it's about changing the market structure, not in the short run. But if you do want to explore what that looks like, I think a gating factor is, some of the capital treatment that's been proposed does feel like, well, that really does limit the amount of risk folks are going to be prepared to take in this space. And it also feels a little bit arbitrary. It feels, personally to me, it feels like it's a number that's a prohibition rather than a number that's calculated on some sort of risk metric. Mm-hmm. And so working through and saying, well, actually, what do we think this market might look like? How would we measure that against other types of risks in the market? And what's an appropriate capital treatment for this type of risk versus, others, I think is the right way to go about it. And I'd like to see that more deployed more actively across a range of different jurisdictions. I think it will be. I think there's been an evolution in how people think about these markets. I think there's general acceptance, and you see a lot more recognition from some of the sort of crypto or crypto adjacent firms about like if they really want access to scalable capital. And there's some sensible things they should be thinking about that include rules and regulations around access or control or reporting, whatever. So I do think that's starting to become more the direction of travel. But I also think it'll take a little while to get there. But capital is probably one that a lot of people are focusing on right now to ensure that the right models are put in place in the right way to enable the right risk appetite at an institutional level to say, well, here's how much we would want to facilitate that type of transaction, and here's why. Because none of us are resource limitless. So, even today, across the product set that we have, we allocate resources, balance sheet, capital liquidity to different products and different entities to different client sets in a way that we try and balance out the demand with the clients and give a fair access to, those clients to sort of work with us in a way that is manageable across the resources that we have. But we can't just do everything everywhere. And so this, assuming that, assets that sit on a public blockchain, whether they be crypto or whether they be other types of assets in a public blockchain, have some risk parameters around them that can be benchmarked against that. Then that enables a more thoughtful decision around well, what products would we offer and how much would that be valuable for clients, and how do we do that in a way that's useful for us as a entity that's due to generate profits for its shareholder as well. So how do we get that balanced perspective?
Okay, and two other things, maybe financial market infrastructure, like what other players in the market would you interface with if you are going to do this in the market, or then also the treatment of certain kinds of potentially new asset classes. Those are things that are still somewhat in flux.
Yeah, so the first one, there's a lot of talk in this space around sort of disintermediation, and you don't need that role, you don't need this role. Like I've said this a few times to different people. I think that's fine later. But if you come back to, there's what the technology can do, there's what we want to do, and there's what we should do. A lot of the roles and responsibilities across sort of different bits of the capital markets life cycle are really well established over a long period of time based on experience and some crises and a bunch of other, things that happened with, we need this role to solve that. And when it comes to sort of envisaging a world without some of those roles, wouldn't it be amazing if? It's like, yeah, it would be amazing. But then when you say to a client, like, hey, we're going to do this, and by the way, there'll be no one to disintermediate the credit risk.
This is what it means for you. Yeah,
it's like, they're like, well, hang on, what? And so you want me to pay a certain amount of money to you for this asset, but there's no one's filling that role. Well, what if it breaks? And, often no one's rushing to fill that space. And so the technology will do it. It's like, well, it won't really. Like the technology might have the capability to execute some of those events, but who owns it? When it breaks, who am I going to sue? Because this is someone's money I'm putting on the table. And that really needs to be thought through. So certainly my perspective on this is if you're going to do something that is reflective of existing capital markets activity, let's say an issuance, and you need an issuer, an underwriter, an investor, a custody solution, a settlement rail, some sort of like mechanism for settlement, like a TA, whatever, have all the roles and responsibilities the same now, just do them in a slightly different way. And that way, at least you're across the threshold of, I understand what that is. I know what rights and obligations I have and they have and who needs to do what, etc. if that's a good way of doing business and there are some efficiencies to be had in that space, it will become self-evident what roles can become redundant. And two things happen out of that that I think are important. First of all, it allows you to get started on something where people can take actual risk. And that's how you learn, like R&D with actual risk on the table and getting into those really difficult conversations about who's going to do what when it breaks. Because happy path's easy. Like that's the core bit. That's what takes a long time. And unless you have those conversations, it will never grow. The second thing is if you say, well, I want to remove this role, I'm going to disintermediate this function. The people in that function, no matter what they are, will fight tooth and nail about why their job is absolutely fundamental to the safety and soundness of the system and they have to be a part of it. And actually, that will kind of derail the whole thing. Whereas if in 2 years they're like, we don't really have much of a role here, like we're investing a lot to hire people, run technology, do all these things, and actually it doesn't feel like there's a lot of value in that, that's an easier decision to say, I might divest myself from that role and responsibility and deploy those resources elsewhere. So you actually need to have a bit more of a steady approach to this. So same roles and responsibilities, same parties in that ecosystem, maybe do it a different way and then go to the next step of like how some of these things might evolve to drive maybe some of those cost reductions you think in the long run, or just simplicity between the mechanism that might change some of the dynamics about how we think about fails or how we think about, the deployment of capital or deployment of liquidity in specific risk circumstances. Well, that'll be cheaper, that'll be better, that'll be lower cost. And then if you can create a market where there's lower cost, then you can do new things in that market. And that's where I think it could get really interesting. But it'll take a while to get there.
For sure. And that's how we think of things too at RuleMatch. Not that all of a sudden you just forget the whole definition of an exchange, but you actually have separation of duties. You have
that's right.
Disinterested parties like an exchange who bring buyers and sellers together. Those things function, work in markets for a reason, right?
Exactly right. Yeah. And it's a really interesting really interesting sort of thought process, because if you accept that a lot of those things are there for a reason, then why change them? It's like, well, there's a difference between the protections and the processes being there for a reason and doing them in a specific way. So if you went back in time and you said, okay, I'm going to start with a new structure for financial markets in this construct. I'm going to look at the history of what's happened over this period of time. I'm going to make sure that I write something new that means these things can't happen. These protections now exist at inception. And I've got a different set of capabilities to start with. It would be a recognizable market structure, but I think it'd be very, very different in lots of ways around like who's in the market, how you access it, what are some of the things you can do, because we don't have to build layer upon new structure and new role and responsibility that actually drives some of the things that then you're a counterpoints to that, like brings other risks into the system. So you could actually design something new. I don't see that as a realistic prospect in the short run. I think there's an evolution process that might occur that potentially sort of evolves or removes some specific components of existing market structures in a way that is, beneficial for broader investor issuer population. I think that's probably what we'll get to. And it's, it's something that we should really be open to thinking about.
If we think just imagining, right, digital asset markets or crypto markets coming in among big institutions, what would be the ideal settlement kind of mechanism? How do you think settlement could or should look in a new market like this?
I mean, the most effective mechanism would be something versus payment with a netting function. So if in any construct you can bring a risk exposure to a multilateral netting capability and then net down the actual funding requirement and then settle that versus payment, that's a great outcome. It's the question of like how frequently you can do that and at what speed. And some folk and it's always an and. People always talk in this space about like, I could do this or that. It's like, well, no, I can do that and that. And in the and space, if I have a process of doing things now and I can do something new, if that new thing is really good, then liquidity will flow there, and then the existing thing needs to think, well, okay, how do I balance that out, or am I comfortable? Is the market comfortable with that transition? So I don't think there's a specific model. It's just, in principle level, netting and versus payments. So I fund as little as possible and I reduce my settlement risk exposure to zero, then that's a good outcome. And whatever model that looks like, I'm sure the market would rally around. And that comes back to whether it's centralized or people like to say decentralized. I don't think decentralized necessarily is where I see
distributed.
Big capital market infrastructure going. I do think that distributed bit. So it's kind of controlled and centralized, but distributed across participants. So that feels like it's an achievable outcome in the medium term.
Let's just shift gears a little bit to stablecoins, which have become a big topic, and that's one of the legislative things kind of on the horizon in the U.S., but also MiCA covers that, and different areas are looking at that. What do you think is a good outcome, or what do you think will happen that could be relevant to big banks, and how would big banks kind of view those developments of particularly dollar-backed stablecoins?
Yeah, look, as long as the playing field for participants in that is level and representative of the sort of risk footprint, then the regulators will set it up in a way that they want to set it up, and we need to be responsive to that. So we're fortunate we've got a unit in our payments business called Connexus, and they've got Connexus Digital Payments, which is about sort of cash mobility, and Connexus Digital Assets, which is the stuff we build on in markets, which does cash versus securities. And so we've got an understanding of how cash on ledger moves and how it could move, and some good and bad things around that, and why things might migrate and whatever. And they've done a lot of research over a long period of time. I think stablecoins are another mechanism for moving cash. If whatever the regulation and the sort of legislation first and then regulation second comes to enable that activity, if that lets us operate, if that's established in a way where it's sets the right risk parameters around what that looks like, and by that I mean level playing field for capital and liquidity if there's similar rules to banks, or if there's not, then that's okay. That'll get figured out, right? So without getting into details there, that just needs to be
fair,
a reasonable risk approach from whatever U.S. market, whatever is wherever that's going to happen, to enable that activity in a way that we'd be comfortable to use it for our clients. And to the extent there are stable coins, and they can be used in a way that is additive to the existing market, and our clients want to do that, then of course we're interested in facilitating that. I think it's really early to say which path we go down. But I think it's also fair to say that if there's a regulated product that meets the threshold of what we can operate in, and it's inside our risk appetite, then of course we'd offer those services. I think there's a few questions that need fundamental, answering before we get to that point, both externally around the legislation and then regulation, then internally around risk appetite. But of course we're looking at it because we need to understand and have a think about and have a view on what that would mean for us, regardless of which direction it went. So we can then think about, well, if that then does come to the market, how do we need to respond to continue to provide the right services for our clients?
Yeah, I mean, because if you talk about cost efficiency or just operational efficiency, it's in some ways pretty hard to beat a stablecoin just for moving value.
But every product has some real benefits, and every product has some areas they need to work on. And I think stablecoins are the same. And you could make a really cohesive argument around how stablecoins bring some of the efficiency, and quite clearly, given their growth, there's a lot of people in the market that see that. So that's a true statement in a bunch of contexts. Yeah. How that then gets extended across other capital markets activity, I think, is still an open question. Is it possible? Absolutely. And it'd be interesting to see how that works. What we would like to see, though, is regardless of the market, we do like competition, and so seeing the right type of products in the market to then compete and sort of have a capability where there's not a concentration of risk in any one institution or one body, I think is probably helpful. So, as that evolves, that'd be good to see that evolve as well.
Probably one of the most interesting kind of stablecoins would be a yield-bearing stablecoin with some aspects that are very interesting for clients. I suppose that would be interesting for an institution.
Possibly. It's not really my area.
Okay.
When I think about stablecoins, I think about them more of as a settlement mechanism for capital markets activity rather than the product in and of themselves. I think that really is more of a payments question because it's and potentially our asset management business, because depending on how you think about what a stablecoin is.
Or a collateral topic.
Possibly, but I think there's a lot of work to do before it crosses the threshold into collateral and uses for collateral. I think what it looks like and what its purpose is and what the rules are, I imagine would be sort of more a payments question because they're the experts on how cash mobilizes around the market. And then if it's yield bearing and people compare them to funds, then that's really an asset management question and how they would think about putting that alongside or instead of some of the sort of LPs for funds. And that, again, they're questions that we'll ask ourselves as that construct gets established. But it's not, when I think about how we in the markets business would interact with that particular product, at the moment, it's very much around could they be used as a settlement mechanism, and if they could, what construct?
Okay. We've talked a lot about the plumbing, and you talk about the settlement and all of those things. There is that other side of kind of the Bitcoin versus blockchain topic where they come together in tokenization, new assets or new things that can be financialized. Some people are very bullish on that side. Larry Fink comes to mind, another big institution. How are you thinking about that space, and what are kind of the upsides and the things where you say, wait, maybe not yet?
So we're really interested in it. We clearly see some value in that. We do that now. We've done that already for 4 years in different ways, and we're going to do more of that. So yeah, there's absolutely opportunity there. But just because it can be mobilized on blockchain doesn't mean that's the right solution. And you think about some products that are very heavily based on their bespoke, high-touch documentation behind them, whether it be loans or whether it be some of the constructs behind mortgage-backed securities before you get them into that structure. Just saying it's possible to move them doesn't necessarily mean they're immediately going to go there. And so I think that's an open question. We absolutely see opportunity. If you could click your fingers and move to a new market infrastructure, a new technology layer, remove a lot of the sort of existing processes and say, let's put this all in a smart contract structure on blockchain, and you've got to guarantee that you're above the threshold of, of course you do that, but that's just not how it works. So there's a lot of work to do, I think, to look at not just the plumbing of how these things operate in the market, but how they get into the market in the first place and what the underlying structure of us deciding to lend to someone or a whole bunch of people who've got a mortgage, having those mortgages sold by the bank into a new structure. There's a lot to do there that is quite complicated, and it should be complicated because it's a relationship between an institution and a borrower. And if you're borrowing from your bank, you want to be considered as an individual in your specific circumstances to get the right deal for you, and that's how it should be on the other, on both sides. So, I would say from a tokenization standpoint, absolutely, we believe it's possible. We do it now. We do see there's a bunch of things that would be more readily available to move into that space. Having said that, there's a bunch of stuff that would be aspirationally good, but really, really hard, and there's a spectrum upon which I think that capability will sort of spread out a little bit. But again, I think it'll take a while because the finality of settlement, the rights and obligations of each participant in that process, who provides the technology, how do things get managed, that's complicated. And yeah.
So some of those things that come to your mind right away that would be, could be, should be tokenized, can you mention some of those things that you think about?
Yeah, I mean, there's a lot of conversation across the market around sort of mobilizing collateral in a tokenized form to support margin. And there's some really interesting questions around that. And naturally there's some opportunities there. And a bunch of different institutions are trying a few different things, and that's great, and they should. We're doing something in our clearing business that we've worked with HQLX and BaFin have just given some recent guidance and approval on to mobilize collateral for margin into Eurex using HQLX in a tokenized form. And we see that's a really positive step to explore, like, how does that add to the overall construct? Because some people are, well, unless you do everything, you get nothing. But equally, without doing something, you don't know if you want to go with everything. So, like, some of these things we think have got real value. So that's the sort of stuff I think is the next phase for us. The other thing that's really important is, we've got a platform, we've been doing a bunch of stuff on that. HQX has got a platform, they're doing a bunch of stuff. Like, HSBC's got a platform, Goldman's got, like, there's a whole bunch of
Everybody has their platform.
Well, not everyone, but there's quite a few.
Yeah.
And I think, we looked early at sort of, well, how's that going to work? How are these things going to fit together? Because I think even if you took the heads of a bunch of large institutions who have their own platforms into a room and said, we all agree that it is more expensive than it needs to be and less efficient than it needs to be for us to have our own platforms. And we go, yes. We all agree it would be cheaper for us to tear up what we've done and start from scratch as a cohesive unit. Yes. It's still not happening because no one's going to say, like, it'll be, yeah, I'll tear my stuff up. And actually, for a bunch of good reasons and frustrating ones, consortiums in the markets are difficult to get moving. So the reality is there will be a bunch of different technologies out there that do different things, but related. And so one of the things that we are doing is demonstrating that that's possible to interact. So this quarter, we should be trading with a client facing us on our repo platform, but their collateral is going to come from HQLX, and we're going to orchestrate the settlement of those two things across using Onero, which is a company that does that settlement orchestration. So you've now got a quarter-based DLT platform, which HQLX operates on, settling facing an EVM-based platform, which our internal blockchain is based on, in real life with real risk. And so when it comes to tokenization and mobilizing collateral across multiple different locations, which is really the longer term objective, if you want to get more efficiency out of it, you need to have that capability to settle across multiple architectures. You give up some DLT or blockchain capabilities by doing that. But if the things that you keep have value, which we think they do, that precision and sort of speed, not instant, but speed of settlement in a precise way, like, that's got value. We've got value for that when it comes to our funding. We've got value for that when it comes to sort of managing intra-liquidity and mobilizing collateral in different ways. So I think that story is something in the tokenization space that will be interesting to follow. And it'll also be interesting to understand how that then interacts those more controlled access private chains versus how they interact with what might be a version of public that we can get comfortable with, if we can get comfortable with it over time. Like, that will be an interesting dynamic, and why wouldn't those things eventually interoperate as well? So that's I think one of the questions the market's going to face. And coming back to your point around, like, there's a lot of potential upside here. There is a lot of potential upside, but there's some key hurdles that need to be crossed in order to realize that.
So maybe eventually it moves a bit more towards cross-interoperable, permissionless, or at least well orchestrated on multiple levels. I mean, that is where a market has to go eventually if it's going to reach critical scale, I suppose.
Yeah, it's interesting you say the word a market, right? Because there are multiple markets.
Sure.
And I've said this in a few different panels and stuff. Like, people talk about fragmentation. It's like, well, markets are fragmented now. Yeah, there is no global market. There is a story about global markets, plural, but there's no global market. There's no one layer, no homogenous pool of liquidity and assets that fungibly exchange with each other in a seamless. It doesn't exist. And actually, I think when you look at markets historically, whether they be financial markets or real markets, there are, under a single market roof, there's often lots of little markets. And actually, having those little markets is actually what a market is, because that drives competition, it drives innovation, and the good solution will attract the liquidity and the sort of buyers, and the other solutions will wither. And I think that's okay. So when you talk about a market, that could be collateral mobilization in Europe. Maybe it's collateral mobilization in Europe and APAC. But it's not, European equities and European fixed income and US equity. Like, they don't fold into one market structure. And I think that's okay. And and people sort of point to that as fragmentation. I don't think it's fragmentation. I think it's just a recognition of how markets work today. And if you can add new things, you don't have to have seamless liquidity interoperability between everything in the market. It doesn't work that way now. As long as the liquidity pool is broad enough and deep enough to manage that resource in a way that's got value for the users, then that's fine.
And thinking about, some of the people, other big institutions like BlackRock, who are quite forward thinking, I mean, there is perhaps potential that some people come together and work together. Do you see that happening on a high level?
Yeah, I think you can look at all the different sort of, whether you call them proofs of concept or R&D efforts or whatever. Like, they're rarely a single institution. They're usually partnerships, and usually partnerships across a couple of different types of institutions. So yeah, I think that's fundamental. Going back to the point of, if you're going to do something new, do it with the same participants, just in a new way. So it's got to be, BlackRock plus a broker dealer plus maybe an issuer plus maybe a customer. Like, there's all of those participants have to be in the mix. I don't think any one institution, whether it be a large asset manager or whether it be a large bank or whether it be a financial market infrastructure, can move the market by themselves. They can provide impetus to that. They can provide some leadership to that by either execution or demonstration of what's possible. But I don't think it's possible for any one institution to move the whole market by itself. So yeah, it's got to be a partnership in some way.
Everybody has to work together.
Not everybody. No, I think everybody would be really bad.
Okay.
Just enough people to get something done.
Yeah.
Because going to the point around consortiums,
yeah, for sure,
too big, it falls over. So it's a fine balance. It really is. It takes some management to get the right balance of participants, like by type, and balance of participants by sort of culture and approach. And that's part of the complication of finding those right partnerships to develop.
Very interesting. We usually end up with a question about what people have in their minds coming up in the next 6 to 9 months. But I thought I would change it up for you today, just a little bit. Thinking about, from the institutional perspective, since we talked to institutions on the podcast, do you think there is one or perhaps two things for institutions like J.P.Morgan, but doesn't have to be concerning you specifically, that would really tip the balance, so to say, towards a real push into digital assets, crypto, if not necessarily wish list, but just knowing and understanding the fundamentals of where things are and where they could be?
Yeah, I think on the crypto public blockchain side, whether it's something that is required or whether it's something that's a hurdle, I go back to the capital treatment. Aligning whatever the capital treatment is from a risk-based approach that's appropriate for the type of risk you're taking, I think would be a helpful step to at least set the right conditions for folks to make a different choice around whether they do or don't want to deploy resources into really understanding their risk appetite and really sort of putting products on the table. I think that's really important, and probably the most fundamental one. And the second one is, I think just getting past some of the fluff. There's a lot of noise out there around how amazing everything could be, and it's all going to be just getting back to sort of brass tacks of what are the products that clients want today that, if done in a new structure, could bring value. Does that mean I'm bringing a new set of clients to a market? Does that mean I'm changing the way that we think about the speed and execution of settlement that has some value, not just because I want to change it, but has some value associated with that? Does it mean I can operate with a new set of clients in a different way that, again, achieves that sort of broader objective of what capital markets are supposed to do in a competitive structure that, like, we're not investing $10 million and realizing one, So balancing those things out, I think that sort of bringing some of the noise back to the reality of, like, what are the right things to be doing when it comes to, like, pragmatic, commercially minded solutions. I think that's the other piece that would be helpful, and those two things aren't mutually exclusive. But yeah, I think there can be a lot less hype and a lot more pragmatism would help.
just do it, so to say.
A little bit. Yeah.
Scott Lucas, thank you very much for joining RULEMATCH Spot On.
I appreciate it. Thank you so much for giving me the time.
Been great. Thanks a lot.
Cheers.